Could the stablecoin boom force interest rates lower? How digital dollars could reshape monetary policy. Imagine a world where digital dollars, known as stablecoins, grow so large that they begin to influence how the Federal Reserve sets interest rates. What if this wave of digital finance could actually push borrowing costs lower? Not just in the United States, but across much of the developed world. That's the possibility raised by Federal Reserve Governor Stephen Miran, whose recent remarks have stirred conversations among economists, investors, and policymakers alike. Stephen Miran, a relatively new member of the Federal Reserve Board and an appointee of former President Donald Trump, recently suggested that surging demand for dollar-denominated stablecoins could lower what economists call R-star, or the neutral rate of interest, the rate that neither stimulates nor restrains economic growth. In his address to a group of economists in New York, Miran said that the growing flood of stablecoins pegged to the US dollar could effectively tamp down this neutral rate, potentially forcing the Fed to lower its own policy rate to prevent an unintended economic slowdown. According to Miran, stablecoins become a multi-trillion-dollar elephant in the room for central bankers. He explained that these digital tokens are already increasing global demand for U.S. Treasury bills and other dollar-denominated assets. As that demand continues to grow, he said, the neutral interest rate could fall further, perhaps by as much as 0.4 percentage points, based on previous research. His argument extends a long-standing belief that the neutral rate is already lower than most of his colleagues assume. But this time, he adds a new dimension. Digital finance might be structurally lowering borrowing costs for years to come. To understand the significance of Miran's statement, it helps to look at his background and the broader economic theories behind his argument. Miran earned his PhD in economics from Harvard and previously served as a senior advisor at the U.S. Treasury during the pandemic, a period defined by extraordinary government spending and ultra-low interest rates. Known for advocating pro-growth and low-rate policies, Miran has long argued that the Fed must be cautious not to over-tighten monetary policy. His new remarks suggest that the digitalization of the dollar could be quietly shifting the underlying mechanics of interest rates themselves. At the heart of Miran's theory is the concept of R-star, the neutral interest rate. Economists often describe it as the economy's speed limit. When the Fed sets its policy rate close to R-star, the economy moves at a steady pace, neither overheating nor slowing down. If R-star falls, but the Fed keeps its policy rate unchanged, the result can be like pressing too hard on the brakes, unintentionally constraining growth. Miran's concern is that the rise of stablecoins is quietly lowering this speed limit, meaning the Fed's policy could become too restrictive unless it adjusts. But what exactly are stablecoins, and why could they matter so much? Stablecoins are cryptocurrencies designed to maintain a fixed value, usually pegged to a stable asset such as the US dollar. They combine the efficiency of digital transactions with the stability of fiat money. The first stablecoins appeared around 2014 and were primarily used in cryptocurrency markets to facilitate trading between digital assets without converting back into dollars. Over time, stablecoins such as Tether, USDT, and USD Coin, USDC, became central pillars of the digital economy, backed by reserves of cash, treasury bills, or other liquid assets. Today, stablecoins are far from niche. Their combined market capitalization exceeds $160 billion, and some forecasts suggest they could exceed $3 trillion by the end of the decade. Beyond cryptocurrency trading, they are increasingly used for remittances, cross-border payments, and even corporate treasury operations. In countries with volatile currencies, stablecoins give people access to dollar-based savings and financial stability. In short, they are reshaping how money moves across borders and how global demand for dollar assets is structured. Miran's reasoning is rooted in classical economic theory, particularly the loanable funds model. In simple terms, when the supply of savings or loanable funds increases, interest rates tend to fall. Stablecoins, he argues, are doing precisely that. They are expanding the pool of dollar-denominated savings globally. Every time a stablecoin issuer creates a new token, it must buy and hold an equivalent amount of reserves, often in U.S. Treasury bills. This sustained demand for treasuries pushes their yields lower. As Treasury yields decline, borrowing costs across the financial system tend to follow. This process mirrors an earlier phenomenon known as the global savings glut, a term popularized by former Fed Chair Ben Bernanke in the mid-2000s. Back then, high global savings rates, especially from emerging markets, flooded the U.S. with capital, suppressing long-term interest rates for years. Miran's argument is that stablecoins could now be producing a digital version of that same dynamic. If Miran is correct, this could have profound implications for consumers and businesses. For households, lower interest rates mean cheaper mortgages, car loans, and credit lines, but also lower yields on savings and retirement accounts. For businesses, it could mean easier access to credit and lower financing costs, potentially stimulating investment and growth. However, there's another side to this coin. If rates fall too far, savers and pension funds could struggle to meet their income goals, and financial institutions could see margins compressed. There are, of course, reasons to be cautious. The mechanism Miran describes isn't automatic. For stablecoin growth to push down rates, several conditions must align. First, stablecoins would need to achieve multi-trillion-dollar scale, enough to materially affect Treasury demand. Second, their issuers would need to continue backing tokens with high-quality, liquid U.S. small assets. Third, adoption must extend globally, with stablecoins becoming a preferred form of digital dollar holding for individuals and institutions alike. Fourth, central banks must recognize the shift in R-star and adjust policy rates accordingly. And finally, regulation and trust are critical. Stablecoins must be seen as credible, safe, and well-governed for this effect to sustain. These are tall orders. While stablecoin adoption has grown rapidly, it faces regulatory uncertainty in the U.S. and abroad. Some governments view them as potential threats to monetary sovereignty or financial stability. The ongoing development of central bank digital currencies, CBDCs, could also reshape the landscape, potentially competing with or crowding out private stablecoins. Moreover, if regulators require stablecoin issuers to hold more capital or limit their operations, the flow of funds into treasuries could slow, dampening any downward pressure on interest rates. Still, Miran's argument raises an intriguing possibility. Digital finance might be bending the rules of traditional monetary policy. If global investors can hold digital dollars freely, the Fed's control over U.S. financial conditions might subtly weaken. The global demand for dollar assets could become even more sensitive to technological innovation and investor sentiment. That, in turn, could influence everything from exchange rates to credit markets. For consumers, the broader question is this: how would lower stablecoin-driven interest rates change your financial life? Would you borrow more cheaply? Would you rethink your savings strategy if returns on cash declined further? And for businesses, would a lower cost of capital encourage more risk-taking, or would uncertainty about digital money's stability make you cautious? The truth is, no one knows for sure. Miran's hypothesis is plausible, but it depends on the scale, stability, and regulatory fate of stablecoins. The digital asset market is evolving fast, and its intersection with traditional finance is still being defined. Yet, even if stablecoins only partially influence rates, their growth underscores a broader trend: the merging of technology and macroeconomics. Money itself is becoming programmable, borderless, and increasingly digital, and that will inevitably shape the cost of credit and capital. So can a stablecoin surge help push interest rates lower? The honest answer is that it could, but not necessarily in the way or on the timeline Miran envisions. Much depends on how policymakers respond, how trust develops in digital assets, and how global investors allocate their capital in this new hybrid system. What we can say with confidence is that stablecoins have graduated from a crypto curiosity to a macroeconomic variable worth watching. They have the potential to change the global financial plumbing and perhaps even redefine how we think about money itself. For now, the wisest approach is to stay informed, stay balanced, and recognize that while innovation often lowers costs, it also introduces new kinds of risk. The key is preparation, not panic. Kindly subscribe, like, and share the video. See you in the next one.